Welcome, everyone. Love the tune. On a Monday, September 21st, 2020, on a day where the Dow, the S&P, the TSX, and all the overseas stocks got hammered, I'd say down about 2% across the board. We are here live. I'm Rob Tetrault from robtetrault.com, portfolio manager at Canaccord Genuity Wealth Management, and welcome to the Tetrault Show. Good to have you guys here. I'm pretty excited about our guest today. I'm going to bring him in right away because not every day we get a president CEO of a Toronto Stock Exchange listed company and a homegrown talent right here from Manitoba, none other, the CEO, the president of Artis REIT, Armin Martens. Let's bring him in. Armin, welcome to the show.
Thank you. My pleasure to be here, Rob. Thanks a lot.
All right. So you've been CEO 15 years, I guess the founding CEO, first CEO there at Artis REIT.
Yes, I am. I found, and my CFO, Jim Green, has founded the REIT with me, with the two last legacy executives, if you will. That's been a very good run. You might remember, or your dad might remember, actually, Rob, how we started 15 years ago with just one building, $15 million property. And we thought someday maybe we'll grow to about $1 billion, but we ended up growing to all over $5 billion in assets and able to create what I think is a very successful real estate investment trust right here in Winnipeg. Never without its challenges, but that's the world we live in. If it was easy, everybody would do it.
$15 million. I do remember that quite vividly. I was a youngster working at Bieber Securities back in the day, an investment firm that my father, Claude, and Guy Bieber were running back in the early 2000s, a privately owned independent investment firm. And you guys struck a deal and you kept growing the position, kept growing the book, and just dramatically improving shareholder wealth throughout the years. Bit of an odd day here today in the market, or is this something you expected? If I look at the Dow here, we finished down about 2%. The S&P 500 rallied here towards the end of the day. It's only down one and a bit percent. NASDAQ rallied really hard. It's almost flat here. Is this accurate? This has rallied a lot here. I'm looking at my screen here. It's moved a ton in the last hour or so. You surprised to see some profit taking here?
Not at all. I mean, it's been an interesting year. We've sank so much. We got hurt so much in I guess it was March, April. A lot of volatility, a lot of pain in the market. And since then, there's been partial recovery. Different sectors. I'm looking how well the tech stocks have done, and the Nasdaq's done. S&P's come back a bit, but September is often a bad month for investors. That's when we get the Black Fridays, the Black Mondays in September. And it doesn't surprise me. And in this, we're in a 100-year pandemic now, for goodness sakes. And so there's still some concern out there, fear and a bit of cynicism as well. Investors and the market likes to shoot first, ask questions later. And if there's any type of a headline or rumor about something bad may be happening, maybe the vaccine will be a month late, maybe there'll be a second surge, maybe there'll be another lockdown. Investors often head for the sidelines, especially if they've got some profit they can take, right? So that's the movie win, more volatility, but I think we're on an upward trend. I mean, there's no doubt in my mind, the worst is behind us for this COVID-19. The worst is behind us. The vaccine is around the corner, even if it's a slow corner. The therapies are there now. If any of us get infected, there's a much better chance of us healing well. So you've got the therapies, you've got the already in place, you've got the vaccine coming around the corner. Economy is recovering slowly but surely, opening up. More and more jobs are being created. We're not nearly where we want to be, but we're definitely on a positive trend line. And I don't mind saying, even at Artis REIT, we're seeing it. We're a diversified REIT in 3 asset classes: office, retail, industrial, and we're seeing the turnaround. We've sort of announced that the worst is behind us for the pandemic in terms of rent collections, vacancies, rental income stabilization, and NOI. We see ourselves now on a positive trend line. We're not where we want to be at. But the retail collections, for example, went from 88% back up to 95%. Industrial is at 98%. Office is at 97%. We're averaging 97% rent collections now. And we bottomed at about 90 in total in May and June. So we're in a much better place now. And hopefully the market's not where we want it to be yet, but I think we're going to get there.
So let's get to Artis REIT in a sec. I will ask you about those numbers a little bit further, and I will ask you to clarify. And there's a bit of a big announcement that you guys, and one of the reasons you're on the show today is I reached out to you. I saw the announcement with respect to AXX and the kind of split from Artis REIT. We'll get to that in a second, Armin. For now, the headlines themselves on the markets, we saw a lot of the kind of the COVID trade, if you will, the casinos, the airlines, the cruise lines, the real estate really got hammered hard today. And now you talked about maybe there's a sentiment that the vaccine might come later. Two questions for you. First of all, when do you think we're going to see widespread vaccination for North Americans? And then second of all, those risk-on trades, if you will, the casinos, the airlines, all that, do you see those sectors bouncing back?
So I'm optimistic. We'll get the first vaccines we'll see already this year. We'll see them this year, but I think widespread distribution will be Q1, Q2 next year, and that's I think that's the sentiment right now. You know, right now, based on what they're saying, right? They're getting, and that's so I believe the reports I'm hearing, and I'm optimistic. We get paid to be optimists, right? And I'm optimistic by, a vaccine will be announced in October, I believe, and we'll see already, the first responders, so to speak, the frontline workers getting the vaccinations first, and then the rest of us after that into the next year. Again, as I said, the therapies are there in good shape. And then you look at the stocks that have been hurt the worst. I mean, the hotel stocks, and the airline stocks, and the cruise ships and casinos. I don't know what to say about them. I remember many years ago, Air Canada went through a bankruptcy reorganization. They came out of it just fine. I am surprised to see our governments beat the hospitality industry down to the ground as much as they are. I'm of the view there has to be a better way to manage through this. We should be able to fly. I've flown a couple of times now within Western Canada. That's our bubble. We can fly. The airports are really safe and clean. The airplanes are safe and clean. I've never felt more comfortable, actually. You wear the mask, you get the fever check, and you move on. I really think our governments can do a much better job of opening up the economy, including tourism. So, for example, you go to Europe, you go to Germany, there's a rule. If you're under one case per 50 cases per 100,000 residences, for example, they've got a metric. Then you're allowed to travel to Germany without self-quarantining. So we can go there from Canada, but to come back, we can't. Germany has good numbers, the same as Canada or better, but Canada is being extra restrictive, in my view, and forcing everyone into this 14-day self-quarantine. Well, then you can't function. 14 days is too much. Maybe a weekend, but not 14 days. So I think we're being too hard, and we're not trying hard enough to help people travel and do business. I mean, here in Manitoba, for example, we can't travel to Toronto yet. I mean, how ridiculous is that? It is the financial capital of our country. They can travel anywhere else, just not to Manitoba. What's going on here? And I'm not saying we won't wear a mask. We'll do everything, all the right things, follow all the right protocols. But Manitoba should be opening up at least to Toronto, maybe Montreal, the cities where we need to do business, because this business by Zoom, it's overrated. It's an overrated experience. It's not the same thing. You need, and here in the real estate business, I need people to be able to see my buildings, right? Tour the properties before they can make a real decision on a lease, before they can make a decision to acquire or sell a property. And the financial institutions, they've got to be able to come to Winnipeg. You can't just say, no, you can't travel to Winnipeg.
There is a sentiment of Zoom fatigue. I've heard that not just from you, from other guests that have been on the show, and from some of my friends. In Manitoba, you're right, we're not traveling as much. Last year, I believe I spent 29 of my 29 trips to Toronto for my office that's in Toronto. I've not traveled since COVID. So for me on the weekend, I participated in a socially distanced croquet tournament, if you'll believe that, Armin. And I won. I actually won the tournament with my uncle, Papa Lou. Big winners in the country, outside, social distance croquet tournament. I never thought I'd participate in such an event, but time on our hands and no travel on our hands allow us to do these things. But I was not touring real estate, as you mentioned. So the travel restrictions, how do you what would be you talked about maybe opening a weekend. What would be kind of any other recommendation on that front, or just kind of reducing the quarantine, or maybe even allowing more countries without quarantine? And obviously you mentioned Toronto. How about the whole country?
Well, follow the science. It's all about the numbers in terms of the number of cases per 100,000 residences. And I think Toronto is down. I think Montreal is down, maybe not all parts of Quebec. And if Montreal doesn't qualify yet, then at least we know Toronto does, Ottawa does. Shouldn't just say all of Eastern Canada, for goodness sakes. That's a very, very diverse geography there, and different densifications of population and caseloads. You've got to be a little more scientific. They keep saying follow the science. Well, then follow the science. Science says schools can open, daycares can open, kids can go to school. That's what the science says. And schools in Germany have been open since May, right from daycare up to high school, because that's what the science says. They don't make it political. And we're being a little overly afraid of certain things. But business travel, there's a certain compromise. Okay, if the government doesn't feel comfortable with too much social travel, recreational travel, at least permit business travel. Let's get the ball rolling. Let's go to put our feet in the water, so to speak. And let's get our economy going. Because at the end of the day, productivity matters, creativity matters, teamwork matters. All of these things you cannot really do on Zoom for long. It's you're buying time with Zoom. That's all you're doing. You got to be able to meet in person, do business in person.
Yeah, for a lot of the sectors, they do operate on a face-to-face handshake. Let's get a deal done type situation, and you're the prime example for that in real estate. So speaking of real estate and speaking of REITs, so a publicly traded REIT is a real estate investment trust. For those of you that are watching the first time, if you've seen my show, if you followed me here, you know that I do have a background in real estate, and you know that I'm a big believer of owning real estate, whether through publicly traded REITs or through privately owned real estate investment trusts, either through a limited partnership. I think for the high net worth individuals in this country, it makes a ton of sense to participate, perhaps in a limited partnership deal or something like that. But for most Canadians, you bring that publicly available real estate with the liquidity. Artis REIT announced in the last couple of weeks that there was a change. So tell us about what's coming down the pipeline for Artis REIT.
Sure, glad to. And first of all, back to real estate. I remember some slides that I presented back in the Bieber security days about hanging on to your assets because interest rates are falling and we're getting sectoral inflation, sectoral deflation. But in terms of inflation, it's in the real asset sector and it's in real estate. Meanwhile, other things are deflating and keeping CPI low and interest rates are low. But now look at the year we're having today. We're not saying billions anymore. We're saying trillions of dollars has been printed by central banks all across the planet and put into and increase the liquidity in our economy. Well, that and sooner or later brings down interest rates, and it could bring them down by a lot. And if you want to, today, 2/3 of sovereign debt is a negative interest rate. Just imagine if European countries are issuing debt and getting paid to issue debt. Imagine if you could take out $1 million mortgage on your house, which we know is worth more, and get paid to put a mortgage on your house. People are paying you to take their money. Yeah,
it's a foreign concept. Most people, they have a hard time grasping that concept.
But if you want to know where we're going in Canada, United States, in terms of monetary policy, whether we like it or not, we're using the same playbook Europe is using and Japan. We're just
the UK announced last week that they were looking at it. They were looking at negative interest rates.
Yeah, we're just not at the same chapter as they are yet. We're getting there. There's no choice because we don't have government that'll give us the fiscal policy, a disciplined fiscal policy. Cutting spending, balancing the budget. Those days are gone. The voters don't even want to hear it. So there's one variable left: bring down interest rates so we can afford the debt. You can't raise taxes either. There's no room there. But so you got to bring down interest rates so that we can afford the debt, and that's happening. If they're doing it in so many other parts of the world, largest economies in the world really, then we're next. America's next. And so that back to real estate is going to increase real estate valuations. The lower interest rates go, the higher real estate valuations go. It's your last place to where can you park your money to get a yield that's tax efficient and hedges against the inflation, while a real estate investment trust does that for you, right? Now in our case, right from the beginning, we've been a diversified REIT, investing in 3 asset classes: office, industrial, and retail. And for many years, that worked out very well for us. We invested in Calgary office, for example. That shot the lights out, 100% occupancy, 10% annual growth. And then that movie came to an end. The Calgary office market collapsed along with the oil market back in 2016. Then a second shoe dropped in Calgary this year with another collapse in the oil price. That hurt their office market some more. In parallel with that, there's been a change in sentiment and change in retail shopping habits, right? The blend between in-person versus online shopping.
The Amazon effect, right?
Yeah, and we're seeing it, and that there's been a paradigm shift, and so that's caused some negative sentiment for retail. And this year, more than ever, we've seen the paradigm shift. I think in a way, it's a good thing. It's a big shock we've experienced with retail shopping because we were shut down. We were shut down, and any and all shopping we could do, we basically did online. We did as little as possible in person, and so that tells you how close we are to this equilibrium between online shopping and in-person shopping. And it's good. Let's just get there. And then we'll know what retail is good to own, what retail is not good to own. In our case, only 17% of our portfolio is retail. 80% of it is needs-based shopping that you more normally do in person. You can sometimes buy groceries online and some things online, but you normally do it in person or you pick it up in person. So we've got a good tenant mix. It's all open air, unenclosed malls. None of our properties are enclosed malls. It's very good retail. But yet, what we've noticed over time is that diversified REITs are not popular with the institutional investor class. Institutional investors want to diversify themselves. They don't want a REIT to do that for them. So they say
they want to pick. I either want residential, or I want retail, or I want office, or I want industrial, whatever. They want to do it on their own.
100%, and they end up by default paying more for them. They end up paying a higher price multiple, but they don't care. That's their business model. And so diversified REITs like Artis and H&R, Cominar, Morguard REIT, we all trade at a lower price multiple and greater discount to NAV than any of the asset classes we own. Now, we're doing better than all of our diversified peers by a lot, but we're still trading below, with about 25% below NAV, compared to the retail at about 15% below NAV, office at 10% below NAV, and industrial's got a premium to NAV. And then you look at the price multiples, we don't trade at one of the price multiples of the three asset classes we own. That doesn't make any sense. We should at least be trading at the worst price multiple, and we're not there. So we get the message. At the end of the day, the customer is always right. And if this is what the investors want, then we should go there. Now, it's not easy to unscramble an omelet, a lot of work involved. But we know what our balance sheet is, our payout ratio. We have a very conservative payout ratio, only 52%. We've got the balance sheet now and the ability now to carve out our retail. It's only 800 million of properties. It's for Winnipeg, it's a big number. It's not a big number for the TSX, but it's 800 million of retail properties that we can carve out into separate pure play retail REIT. We'll have a separate listing, AXX.UN instead of AX.UN. It'll be good retail. It'll have a conservative balance sheet, a conservative payout ratio. It'll be very good yield investment product, and it'll be open for business. And by that I mean, I think it has the potential of being a good aggregator of other retail properties. There's a lot of retailers looking for a home and a way to get listed, and a way to achieve more liquidity for their investors, and a way just to be valued separately and to unlock value. So now, when people say to me, "What are you getting? Are you getting any value for the retail properties in the REIT right now?" And I'd say we're probably getting negative value. But so we need to carve it out. It'll be 750 million of assets. It'll be 45 million of NOI. Conservative balance sheet, as I said.
So I'll slow you down a little bit, Armin. I'll slow you down a little bit, sorry, because you do have a really good deck that's built on this. So maybe what I'll do is I'll ask you to take our viewers through the deck, because it's a lot of complicated calculations. Might make more sense for them. So this is a deck that you had sent me a while ago. It's a portfolio spin-off deck. It talks about what is happening. Before we get into the actual details, there's a disclaimer here. Again, we're not your portfolio managers. Armin isn't suggesting you make investment decisions based on this. Neither am I. Talk to your portfolio manager. If you don't know who to talk to and you want to talk to a portfolio manager, please go to www.speaktorob.com. We'd love to book a no obligation consultation with you to chat about this or anything else that's on your mind with respect to your wealth. I'll also say, if you're watching on YouTube, please take a sec to subscribe. If you're watching on Twitter, LinkedIn, Facebook, take a second to like, to share. We'd love to hear your comments. And to all the viewers, thank you for watching. So I will take you in through this deck. I'm here live with CEO and President of Artis REIT, Armin Martens. Armin, the executive summary here, you talked a little bit about this, how the diversified is trading at a dramatic discount, a 37% discount to NAV overall. And you guys are trading at a 27% discount to NAV versus office and retail that are trading at 15 and 18% discount to NAV. So this is exactly what you're talking about, right?
100%, and that's the challenge. It's been chronic and structural for many years. You might recall a couple of years ago there was a REIT called CREIT, Canadian Real Estate Investment Trust in Business. They just 2 years ago got sold and merged into Choice REIT. But for many years, CREIT had a conservative balance sheet, conservative payout ratio, and they traded at NAV or premium to NAV. But even they got hit, and in the last couple of years before they sold to Choice, they started trading below their NAV, and it was always about, well, you're diversified, you're not a pure play. And if you go from one noise or one storm to the next, once investors might have fear of Calgary office market, and then after that they might have fear of retail or this or that. You really need to cover your whole, categorize and isolate the three REITs and make them pure play. Easier then for investors to appreciate and understand, easier for analysts to analyze and value. And then, of course, at the end of the day, it unlocks value. As I said, if the customer is always right, if the investors want pure play REITs, then we have to go in that direction. I've met them all, from whether it's Montreal, Toronto, Winnipeg, Vancouver, or New York, or London, and Hong Kong. I've met them all, these institutional investors and ultra high net worth wealth managers. They say, no, I want the pure play. And so that's the direction we're going. And as I said, and I see you've turned to the next page.
Yeah, so this one is the overview of the new. So you talked about the spinoff, AXX. That's going to be just the retail segment. That's going to be a totally new stock symbol. So anyone who owns your share, one share of Artis REIT, AX.UN, on a go forward after this, and I'll ask you about timeline, but they'll own one share of AX.UN and one share of AXX.UN, correct?
Correct.
And then what's the timeline for this?
So we're moving forward we're making an application, of course, for our tax ruling. That'll be part of our part of the process. We're preparing an information circular. It will be with fulsome information in there, more information, more details. That'll be ready by the middle of October at the latest, we believe. So once the info cert goes out, then the clock starts ticking. We think by the middle of November we'll be able to have the unit holder vote. So everybody gets to vote on this, and we'll make our case to our unit holders that they're doing the right thing by voting in favor of this. And then assuming it passes, the closing will be in Q1 next year. And we're hoping for January, but it could be a little bit longer, but it'll be in Q1 next year. And then we'll have two operating REITs. It'll be easier. Then the other REIT, I mentioned the retail REIT, what will be AXX, about 780 million of assets, a good balance sheet, good payout ratio, good cash flow, always positive cash flow. But Artis itself, AX, will have about 4.4 billion in assets. And again, conservative balance sheet, conservative payout ratio, and easier as an office REIT, industrial REIT. It'll be easier for investors to appreciate and to value. And it's about unlocking value as we move forward during the course of the year. If it's the right thing to do, we'll split it off into two more REITs after that. We'll spin off the industrial as well. We'll have three pure play REITs, right? Yeah. Whatever it takes to unlock that value. But right now we've got the balance sheet in place and the ability to carve out the retail. And as we can move forward, I sort of skipped over this, but part of this is selling more properties, selling non-core properties, mainly office and some more retail. This continues to improve the balance sheet. And as we move forward with that, then we'll be in a position next year, if it's the right thing to do, to spin off the industrial from the office as well. So at the end
of the day, Armin, this is basically for the viewers in a nutshell. And I'm going to try to paraphrase, and you can tell me if I'm right. Whatever, let's call it $1 of revenue today. That $1 of revenue today is trading at a 27% discount to NAV. For every $1 of revenue is trading at a 27 discount to NAV. Your view is that we split it into 20 cents, 40 cents, 40 cents, and I'm paraphrasing, those accumulated values will no longer hopefully trade at a discount, trade at NAV, or maybe even a premium on the industrial side. And then your $1 of revenue will hopefully trade at NAV or closer to NAV, which would create a 27% bump on the value of the shares in theory. Is that am I kind of close?
Well, exactly. The retail REIT should trade at a lesser discount, should trade at about an 18, 19, say 20% discount to NAV instead of 27. And the office component should be valued, worst case at about a 15% discount. And the industrial component should be valued at a premium based on the data, right? And at the last slide, I even show you how the price multiples work and how we could be improving them on trading. But I don't want to get ahead of myself. You can take your time and walk me through this.
Yeah. So right now it's about 20% retail, 35% industrial, and roughly half office. Correct?
Right.
This slide is a good indicator. The geographic diversity is very impressive. You've dramatically changed it since I first owned the stock back in the mid 2000s. But it's now there's U.S. exposure. Alberta used to be, from what I recall, used to be like 100% or like 80%, and now it's a dramatic minority, right? It's what would Alberta be now? 8%, right? Geographically.
Correct. Once we do split off, it's 16%. But sure, we used to be 70% Alberta, for example, and 35% Calgary office. So we've taken great strides to improving the REIT and diversifying in that sense. And so now we're down to 16% Alberta altogether. That comes down to 8% for the office industrial REIT later. We're down to only 17% retail, only Western Canada. It's a very good focus. So we've made a lot of improvements geographically and by asset class.
Do you think you're in the penalty box, the stock, a little bit because people associate you with that oil and gas office Calgary space?
Possibly. I mean, in this year, you know, there's always a new penalty box every year. It seems like this year retail is more out of favor than ever. Like last year, it was out of favor already. You know, last year you might recall we ran a strategic review, so we met investors from around the planet, and we talked about artists. Talked to us about artisans, and the common denominator and theme was, well, we like artists, but don't necessarily want to invest in retail. And last year we said, look, it's good retail, but the sense we got clearly, Rob, is that retail was out of favor last year. Well, now this year it's out of favor even more. You layer onto that office, there's a bit of fear of this WFH, work from home. There's a fear of that. Now I think it's overdone. I think we get to a nice equilibrium where work from home might be 1 day a week, maybe 2 days a week. I think the balance to that is that people do need to work at the offices to be more creative and productive. And I think employees now need more space per employee. Employers need more space per employee. There's a greater demand for suburban offices as well because of the cheaper rent and the parking. So I see there's an extra layer of uncertainty that the market needs visibility. So we got to get past this pandemic, and we are getting past it, but the market's looking for more visibility. So there's always a new penalty box to jump into just when you think you're always on one.
So I'm going to skip over this a little bit, but this talks about how you're. Sorry, go ahead, Armin.
I was just saying, but then when you get into pure play situation, then at least you know where you are. Retail is retail. We discuss it and analyze it and value it, and investors know what they got. It's listed, and the office is office, and industrial is industrial.
Let me jump to that, Armin, because I do want to respect your time. So I'm going to skip ahead of by the way, if you're looking to get your hands on this presentation, Armin, am I allowed to share this with the viewers, this presentation with the?
Yeah, we did. Yeah. It should be on our website as well.
Yeah. So if you want this presentation, you can reach out to us, go to www.speaktorob. Happy to send it to you, or just reach out to me at my email or on Artis' website. There's some really neat information on this, but I do want to take you here to the valuation. I'm gonna. Where am I here? Is it this sheet here? Yeah, right here. I want to take you to the peer multiple valuation, because at the end of the day, Artis Retail FFO, so funds from operation. This is how REITs, publicly traded REITs, are measured and multiplied. There's 23 cents of revenue there. 23 cents. There's 66 cents of retail revenue for Artis REIT, and there's 48 cents of industrial funds from operation, FFO. So averaging these multiples, this is this is big picture, but the market will decide basically what the 23 cents of retail revenue is worth, right?
Yeah, but we're just taking today's multiple in these COVID times, not pre-COVID where they would have been higher. And we're taking the bottom half of each sector. We're not taking the average of all the retail REITs, average of all office. We're taking carve out the top half, take out the bottom half. So the bottom half of the office REITs, that average multiple you can see is 9.2, and then the bottom half of the retail REITs, so the bottom two actually, is 9.1. And then the bottom half or two of the industrial REITs is 15.3. You correspondingly use those price multiples, 15.3 times our industrial FFO, 48 cents, and then go down to office and retail. You get today a price of $15.52, not $8, either not $8 or $9. And if you wanted to go to worst case scenario, Rob, take the lowest trading retail REIT, lowest trading office REIT, the lowest trading industrial REIT. You would have a price of $12 today. So
that's using the lowest valuations for all three.
Lowest. Take the bottom of the pack. And we know that we're better than the bottom of the pack. We've got a great balance sheet. We've got a very conservative payout ratio. We've got good real estate, good growth profile. And so we're just saying, look, we're not in at a worst case scenario here. There's such a gap. So there's just mispricing and dysfunctionality in the public markets at times. And it's nobody's fault. It's just that investors prefer pure play.
I'm here with Armin Martens, President CEO of Artis REIT. And what I like about this deck, and the reason I reached out to you, this isn't like a projection where you're saying in 5 years, we expect our revenue growth will be X, and we expect that the multiple will grow based on the changing marketplace. No, you're basically saying, this is our current book. This is our current balance sheet. This is the current FFO we have. We're going to divide it in three. It's kind of like having a chocolate bar, and you divide it in three. And you're saying, who's going to pay what for that chocolate bar? You're basically saying here that the REIT is dramatically undervalued because it's a diversified REIT. And the fact that you're going to go specific office, specific industrial, specific retail, obviously in your mind, it's going to have a dramatic, I shouldn't say dramatic. Well, maybe you'd say dramatic, but I mean, $15 and even $12 using the worst valuations is a far, far cry from the, where do we finish today? 832 or something like that, 821 price of Artis REIT, wouldn't you say?
100%, and good point you raised there, Rob, because this is basically empirical data. This is factual data. And FFO can be reconciled with GAAP accounting. It's all factual based on market data today. It fluctuates daily, but there's such a gap and such an opportunity to unlock value when we spin off the retail and move forward as a REIT. And so that's what we're doing. And the investor can only win by supporting this vote. There's only you'll shoot yourself in the foot if you don't support this.
And remember, the market is currently pricing REITs. So if you're out there and you're watching and you're saying, yeah, but Rob, you haven't factored into the fact that COVID, well, or Armin, you haven't factored into the fact that COVID. You would say, no, this is what the market is currently pricing these REITs at. This is a dramatic discount from what they have traded at in the past. All of the REITs have been hammered in 2020, and you are using current valuations on those metrics.
Exactly. These are not pre-COVID pricing. These are current in the heart of COVID pricing. We're all of these other CEOs would say they're being hammered too.
Yeah, if I were to get them all on the show. So I know we're running tight on time, but I just want to ask you maybe your last thoughts about multiples of REITs. So right now they're trading at a discount. Do you see multiples of REITs coming back to pre-COVID, or do you think this is the new norm for REITs right now trading at a pretty significant discount? I'm not asking about your stock. I'm talking about generally the market and the discount that applies to office and retail. Do you see that ever coming back?
Well, I see, for example, yes, for sure for industrial and for multifamily, they're already trading. If you want to buy an apartment building or buy an industrial building, you're paying pre-COVID pricing already anyways. And rents are back at pre-COVID pricing. Our industrial portfolio is performing excellently. Our rents it's as if the pandemic didn't happen for our industrial portfolio. And we can sell at a top price if we want. We're getting the top dollar. We're growing our industrial rental rates and industrial NOI. We don't own multifamily, but we know others who do. And I know some of the CEOs of the multifamily REITs, they're doing very well. Now, there's some rent control issues out there for multifamily that's affecting them. But I think by next year, they get back to pre-COVID multiples along with industrial. Office will be next. Office will recover next. Retail will take a little longer because of the negative sentiment. We need to see that equilibrium. I think we're there basically because of the shock we've taken to the system of kind of a blend of online and in-person shopping. But it needs to filter through. If the enclosed malls are the most challenging right now, the open air, the open air unenclosed malls, those needs-based retail will perform the best. So then you have to also bifurcate and separate the type of retail, right? So that retail and hotels, they'll recover at the end. But office will recover very nicely the next year, and the office market should be really strong next year. But multifamily industrial will recover first. Okay,
so I guess the point is that if you own real estate in your portfolio, I think what you would say is, you're getting paid. I shouldn't put words in your mouth, Armin, but I feel like what you're saying is. What's that?
You're getting paid while you wait.
That's one that I think you made famous. So that's a great point and a good summary. If you want to get this chart, please reach out to us, or the entire deck, please reach out to us. I had about a half hour today with Armin. I've gone a little bit late, so I'm going to thank our guest, Armin Martens, President CEO of Artis REIT, for coming on the show today. Thank you, Armin.
And I thank you, Rob. If you don't mind, I'll give me 10 more seconds.
I'll give you as much time as you want.
Yeah. So again, a REIT like Artis does actually have a conservative balance sheet. That is only 52%. That's really on the low side. We're bringing it down to 45%. We have what I call a bulletproof payout ratio, 52%.
Let's pause and explain that, because the payout ratio is the percentage that is paid out to shareholders annually. Typically, the REITs are at 80, 85, 90. Some historically were above 100%. So your payout ratio, and that's a payout of the AFFO or the FFO?
That's of the AFFO. It's like 35% of FFO. It's a very conservative payout ratio, positive cash flowing, and so investors are when you invest, you're parking your money very well with us, investing very well with us. We've got a good plan to unlock value. There's no risk of a distribution cut. There's no risk of hitting any speed bump or hitting a brick wall. We're in a very good place right now with a very good future. So I do want to encourage investors to be positive.
Yeah, 52 payout ratio, that just doesn't exist in the REIT space. It's just, that's got to be the lowest on the street, I would imagine, or one of, if not the lowest on the street.
Lowest of the commercial REITs. Some of the multifamily have lower, but it is the lowest of the commercial REITs.
Lowest of the commercial REITs. Okay, so in other words, the funds from operation could drop another 50%, and you would still have the cash on hand to make the distribution.
Well, exactly.
So like the dividend is
which will not happen. And I should point out again, and I might have alluded to it. We're 83% office industrial, only 17% retail. We've got pretty good retail. It's performing well, but the worst of the pandemic is behind us at Artis REIT. At the bottom, we've turned things around. And so we've got that going for us as well. It's the right time to get into a REIT like Artis for sure.
Yeah, point is definitely made. Obviously, your opinion's biased. You're president and CEO, but the math certainly makes sense here as I look at the peer multiple valuation, the balance sheet, the dividend payout ratio, what's likely to happen to the valuation as the stock gets split between AX and AXX.UN. Again, I'm not making a prediction, neither are you. But the numbers, they speak for themselves. Did you want to add anything else on that, Armin?
And I know on that note, I guess I'd better quit. I've been a little promotional, but I do get paid to be an optimist. and I want to thank you, Rob, for hosting me on this show. I appreciate it very much. All
right. Well, thanks so much, Armin. So I want to thank you again. If you're watching on YouTube or Facebook or Instagram, or please make sure to subscribe, follow, and like. Please make sure to go to www.speaktorob.com if you'd like to book a no obligation consultation. Again, I was Rob Tetrault from robtetrault.com, portfolio manager at Canaccord Genuity Wealth Management and the Tetrault Wealth Advisor Group. Today is September 21st, 2020. The Dow finished down about, what did it finish down? 510 points. S&P 500 down 38 to 3281. And the NASDAQ down only 14 points at the end of the day. A bit of a rally there towards the last hour or so of the day. Thank you so much for tuning in. Next week on the show on Monday, we have Keith Hontz, CEO and president of Savantis. So pretty excited to have him on the show. Really, really neat perspective. That is Monday, September 28th. One day before my dad's birthday. September, it's anniversaries and birthdays for my parents. It was their anniversary on Friday, their wedding anniversary, and now my dad's birthday next week. So thanks so much, everyone. You guys have a great rest of the week. And one last thing I'll say is this week, historically, the week after the third Friday of September, Kevin Vandermeer sent me a note today, historically, the worst week in the market annually. So I think it was annually. So I guess not surprised to see a big 800 point or 600 point negative day. Have a great rest of the week, guys. Hopefully the market picks up and hopefully the snow doesn't come soon here in Winnipeg. Take care, guys.
Thank you.